Holidays, eggnog, turkey, presents. People, as they get towards the end of the year, they start to get a little bit stressed about taxes. No one likes dealing with this. There are certain things that you can go and do to make sure that you're tax aware in managing those portfolios. Last thing you want to do is get on January 1 and realize that you didn't do something that you could have that could save you several $1,000s in taxes. If you have some free time, make sure that you kind of have a list to make your life easy next year in preparation for taxes. Welcome to another edition of Wealth Strategies Unleashed with Concenture Wealth Management. I'm Robert Gilliland, and
I'm Mike Alexander.
Hey, Mike, thanks for making it in. Just as kind of a refresher, you're the Chief Investment Officer. Give like 2 seconds on kind of your background so people understand exactly how smart you are.
Well, so I've been in the industry about 30 years,
You don't look that old.
Despite my youthful appearance. And previous to getting here, I'd spent the last 20 years working for BlackRock and worked in a variety of roles there. But before I left, I worked on our multi-asset income team there, where we developed strategies that were designed for clients that were looking for income, both institutional as well as retail clients.
Gotcha. Hey, so, going through thinking about this, we're stepping into the end of the year. At this time, people are thinking about holidays, eggnog, turkey, presents, everything that's inside there. But a lot of times people, as they get towards the end of the year, they start to get a little bit stressed about taxes. That, in fact, you realize that in the month of December, that is the time that Goodwill Industries gets their largest number of donations, is because everyone wants to go to get them for the tax write-off.
Whether they get one or not.
Yeah,
I mean, these days, a lot of times people don't get that tax write-off, but they're still trying to kind of clean house, if you will, and make sure that they get whatever charitable donations they can get in.
That's right. So let's spend some time kind of chatting about taxes as you're walking into the end of the year. Everyone hates taxes. I get it. Mm-hmm. As we're walking into the end of the year, what do you think?
Well, I think the first thing is making sure that you have all of the your accounts funded, if you will, for the year. So if you've got things like an HSA, or you've got a 401k, or you've got you need to fund an IRA. I know a lot of times people will wait till their tax filing deadline to do that.
Right.
And they certainly can do that, but a lot of times that will happen at the end of the year as well, just in terms of kind of checking the box and making sure that that's done, right?
You go and you think about, that's exactly right. Well, you go and you think about this checking of the box, right? So some of the things that you need to do as we move in here to year end is that if you have some free time, is go ahead and make sure that you kind of have a list to make your life easy next year in preparation for taxes. Go ahead and make a list of places that you've made donations and things like that. It makes a lot of sense to go back and look at your W-2 to see make sure you have the right number of dependents and things that are in there, making sure that your HSA, like you said, the FSA is up to speed. Now, one thing that's vitally important is if you are required to do a RMD, required minimum distribution, you have to make sure you get it done before December 31st.
Why are you talking to me? I'm not 70 and
No,
a
I'm
half.
just looking because you're across the
okay.
way. Although 35 years in the industry, you might be. But you got to make sure that you get your RMDs. Failure to get your RMD done is a 50% tax. And so you need to make sure that you get that taken care of. Now, if you really don't need that money, you can always do what is called a QDC, Qualified Charitable Distribution. And what you end up doing there is, instead of you taking delivery of your RMD, it goes directly to the charity. And so that's a great way if people are charitably minded. The other thing that we talk a lot about with people is that if you've had a really great year and you're charitably inclined, think about a donor advised fund.
How does that work?
Well, donor advised fund. So let's say I give $20,000 a year away to different charities and different things like that. And I've had a really, really great year. I can take $100,000 and put it into a donor advised fund and get the tax deduction as if I donated $100,000 this year. Now, just make this assumption, over the next 5 years, I'm still giving out my $20,000. I don't get a deduction then, but it's a way for me, in effect, to take the tax deduction and prepay donations to charities that I'm committed to. And so it's a great way to kind of go through to manage the tax. One of the things that we've used it with people is if they've exercised stock options. If there's been some sort of windfall or a sale of a business, or they had a investment property that they needed to sell, they can use that to go through to kind of offset that. The last thing on your checklist that I would argue with people or suggest to people, I do think that it makes sense, though there's not a lot of these given the last 2 years, is go through to see whether or not you can do any tax loss harvesting.
Yeah, maybe a really difficult year to actually find some of those. One place where someone might be able to find them, though, is in on the fixed income side of their accounts, where I'm going to say the bond aggregate is only up about 2% for the year, and so a lot of that obviously has come from income. So there may actually be harvestable losses on that side. Where they can reset that portfolio, especially if they've already taken gains within portfolios. So just, it kind of is an FYI, maybe a place to look. You can also find it in places like tax-free bonds as well. Won't be everywhere, but if there is a place to look, that's probably the place to be looking.
There's one more, and I'd love your insight on this: open-end mutual funds. If you have an open-end mutual fund and you invested in it a couple years ago, and you've been having dividends go through to reinvest.
Right.
And I notice this a lot in international, in emerging market, and things like that. So I put $10,000 into it, and let's just assume that it's paid dividends, right? And now it's worth $15,000. I might have some section of those shares that have been reinvested or dollar cost average, and then I may have a tax loss, even though I may be ahead.
Right.
Overall.
Yeah, I've made money, but on paper, I've still got that tax loss that's sitting there that I can harvest.
And so it might make sense to evaluate your open-end mutual funds, just so everyone knows, generally speaking, open-end mutual funds are the things that have 5 letters.
Right.
Right? And so it makes sense to go through to look at that. What else with regard to taxes would?
Yeah, for the end of the year, I think there are things like, are you going to fund a 529? I think those are things that can be done as we approach year end. A lot of times that's done just from a gift giving standpoint. So it's always a great time to be doing those. If there are catch up contributions to retirement accounts where you haven't made that, maybe there was maybe you crossed over the threshold and you can make an extra contribution for that. So just making sure that people are understand if there's an opportunity to do that. That they make sure to do it.
The other thing that I forgot to mention as we move here into year end is it absolutely makes sense to stop, pause for a second, and figure out whether or not it makes sense to do some sort of Roth conversion from your traditional IRA. As the law stands today, clearly subject to change, is that we really only have 2 years under the current law until January 1st of 26. So if you're going to do a Roth conversion, you may want to go ahead and get that Roth conversion taken care of, so that way you can get at least 2 years inside there, and that potentially could make a huge difference.
Absolutely.
As we move into the new year, I'll kind of kick off a couple things that people should have on their radar to think through that can help minimize their tax burden starting in January. One of them can be, right now we're in or around the enrollment period for healthcare, right? So if you're in the high deductible plan, make sure that you're funding your HSA.
Right.
If you're not in a high deductible plan, make sure you're funding an FSA, flexible spending account. Doing both of those because those funds go in there before tax. Make sure, and if you have room, you're not maxing out your 401k, increase that at least 1%. Again, making sure that you're on your paycheck and on your tax forms that you have the appropriate number of dependents so that they're withholding the right amount so you don't get hit with penalties, possibly even avoiding that. What else would you go and say?
This may be associated with taxes to a certain degree, but I think also, especially if you're coming up on retirement, you're just making sure that you're taking a look and reviewing what your Social Security benefits might look like, especially if you're planning on retiring in this upcoming year. That can change, obviously, how you might want to distribute monies out of your retirement accounts as well. So just taking a look at that, I think it's always worth reviewing every single year and just kind of taking some inventory there.
I agree 100%. Kind of as we go forward, this will be a bit of a review. Let's kind of play a little bit of a game and see who can come up with the most. When you're going through looking at your plan for next year, even finishing up this year, what are some of the most tax efficient vehicles for investing?
Yeah, it's a great question. We get asked it all the time. Without a doubt, ETFs have always been very, very efficient. At least efficient, not necessarily efficient from buying and selling, and you're actually taking a capital gain, but just in terms of distribution of capital gains within the portfolio, they've been extraordinarily tax efficient over the years. So essentially, in many of them, where you're really going to pay your capital gains if you actually buy the ETF right. and sell the ETF, but you're not necessarily getting a lot of taxable capital gains as a result of just holding it.
Right. So I would say municipal bonds.
For sure.
Kind of a no-brainer. Municipal bonds, income from that is federally tax-free. Mm-hmm. And if you don't have a state income tax, that means that it's 100% tax-free. Now, if I live in a state that has a state income tax, if I have municipal bonds of that state, then it's 100%. Otherwise, I'll have to pay. So, like in other words, if I lived in an income tax state income tax state, mm-hmm. that's hard to say, and I had a bond out of Texas, I would have to pay state income tax on that income. But other than that, that's not a problem.
Yeah, other areas to think about from a tax perspective as we head into the new year are, where do you own some of your assets? So it's really about asset location. So if I'm in a high tax bracket, for example, I may not want to own, things that generate, regular income.
Right.
I may not want to own those outside of retirement account, for example, if I don't have to.
Right.
Because I'm going to have to pay ordinary income tax on those versus maybe qualified dividends, which are a lower tax rate. So those are things that I think individuals can think about as well.
Right. So I'm just going to go ahead and knock one out knock a type out, right? A genre, if mm-hmm. you will. IRAs, Roth IRAs, 401k, simple plans, SEPs, simplified employment pension plans, those types of things. All of those, I think everyone's smart enough to understand what the benefits to those and getting those maxed out. So I'm going to take mm-hmm. those. But what I will do and go and say is, and we don't spend a lot of time talking about these because we don't use them that much. We only use them is annuities, mm-hmm. right? And annuities give you a lot of tax deferred growth or tax advantages inside there. And at times, depending on the annuity, can give you tax favored income because some of it's considered a return of principal. Mm-hmm. So I just kind of knocked a whole bunch out trying to win this game. So you go now.
All right. So again, one that, people don't always think about it when they think about investments, but it would just be thinking about, insurance because insurance proceeds, are not taxed. So,
okay. Okay, so
life insurance proceeds.
I think I'm fixing to take it completely over the top and win right here. One of the things that a lot of people don't understand, because in the past, I'm going to call it 10 years, owning rental real estate or income producing real estate has really become a big thing. I would say and you have to, I know you'll agree with this. I don't go a week where someone doesn't say, hey, what do you think about buying some houses? Right? So if I go and I buy a house and it turns into, and it's a piece of property, it's not my primary residence, and I turn around and it's been producing income for me, right? And I turn around to go and sell it, if I sell it at any price above the price I paid less the depreciation,
right.
I'm going to have to pay capital gains. So now, you can avoid that by what's called a 1031 exchange. But a lot of people, or at least my experience, when people decide they're going to get out of real estate, they want to get out of real estate. They don't want to be a landlord anymore. They don't want to be an Airbnb.
They don't want to move from one to another.
Yeah. And so one of the ways that you can do it is there are vehicles called 1031 funds or 1031 exchange funds where the money actually goes into a fund. You avoid that. You can get some income. Now you're just deferring the taxes, but that's one route that you can go is 1031 funds.
So is this the part where I raise my white flag and
say you give up? I won.
You
ding,
got,
ding, ding.
You got it
champion.
on that one.
All right. Well, do you have any? What about, is there anything else with regard to taxes, the end of the year, beginning of the year, that you think people should keep top of mind?
You know, the one that does come to mind, and I don't think people necessarily always think about it, you know, all the time, but when you've had markets that have done really, really well, it's not uncommon for investors to take a little bit off the table at the beginning of the year. And the reason for that, obviously, is now you have your gains that are already sitting there. And if you have a period of volatility through, you know, as the year goes on, I mean, right, we all want to make money. I just want it to go up. That's all I wanted to do. But the reality is that somewhere along the way, you look at a year like, you know, 2024, where we've had something like 5% corrections and 10% correction. So somewhere along the way, you get an opportunity perhaps to harvest a loss to offset some of those gains that you've already taken. So it's not uncommon to see that. That's not, you know, it's not a recommendation to sell in January. It's just to say, if you've got some things where you're like, look, I'm overweight this area because it's done so well for me, it's not a bad idea to think about it.
Well, we all hate taxes.
Does that mean I win?
No. That was
a bonus question.
Yeah. So no, I think that was good. That was good information, though. But you know, as you go in, no one likes taxes. No one likes dealing with this. The key is that it doesn't matter if it's beginning of the year. There are certain things that you can go and do to make sure that you're tax aware in managing those portfolios. We call it tax alpha. And the reality is that if we go through and manage a portfolio the right way, we can basically go through on average, and the numbers show, and studies have shown, that you potentially could add as much as 1% to the return by effectively tax managing a portfolio. And that's why that becomes important. As you're at the end of the year, the last thing you want to do is get on January 1 and realize that you didn't do something that you could have that could save you several $1,000s in taxes. So
smart.
With that, Mike, I want to say thank you. It's always a pleasure having you on the podcast. And we will see everyone next week on Wealth Strategies Unleashed with Concenture Wealth Management.
The information contained herein is intended to be used for educational purposes only and is not exhaustive. Diversification and/or any strategy that may be discussed does not guarantee against investable losses, but are intended to help manage risk and return. If applicable, historical discussions and/or opinions are not predictive of future events. The content is presented in good faith and has been drawn from sources believable to be reliable. The content is not intended to be legal, tax, or financial advice. Please consult a legal, tax, or financial professional for information specific to your individual situation.
This work is powered by Concenture Wealth Management, registered representative of Sanctuary Securities, Inc., an investment advisor of Sanctuary Advisors, LLC. Securities offered through Sanctuary Securities, Inc., member FINRA, SIPC. Advisor services offered through Sanctuary Advisors, LLC, an SEC registered investment advisor. Concenture Wealth Management is a DBA of Sanctuary Securities, Inc. and Sanctuary Advisors, LLC.